The global music industry is reporting record billions in revenue, yet the creators of that music often receive only fractions of a penny. Wall Street firms have positioned themselves to capture the profit before it ever reaches the artists. The mainstream narrative suggests a period of historic prosperity. The RIAA's most recent annual report highlights a new high of $11.5 billion in U.S. wholesale revenue. This growth is supported by a massive expansion in digital adoption. IFPI data shows that the number of paid streaming subscribers has reached 837 million worldwide. Physical media is seeing a similar surge. Vinyl sales have logged their 19th consecutive year of growth, offering a premium revenue stream that relies on tangible collector demand. Analysts at Goldman Sachs expect the industry to reach a $200 billion valuation by 2035. They attribute this growth to emerging markets and the aggressive monetization of dedicated superfans. Monthly subscription fees are now utilized as capital for a financialized corporate machine, failing to provide the democratization of income promised to independent creators. Modern licensing relies on a specific financial mechanism. Major streaming platforms pay record labels massive, non-recoupable advances and minimum revenue guarantees just to access their music catalogs. This creates the breakage loophole. When an artist's streams fail to meet the initial advance, the label retains the unallocated difference. This allows labels to capture billions in surplus cash. While artists trigger the payout, the surplus is rarely distributed to them. Labels further protect their margins through cross-collateralization. If an artist has a successful second record, the label uses those profits to pay off the unrecouped debts of their previous, less successful projects. This accounting structure keeps many artists in a perpetual cycle of debt. They remain officially unrecouped on the label's books, meaning they are excluded from royalty payments while the label collects the streaming revenue. The streaming model operates as an arbitrage system designed to capture corporate surplus rather than as a tool for distributing fair payments to artists. Since labels proved that music generates reliable, recurring revenue, Wall Street began treating songs as high-yield financial assets, similar to real estate. This catalog gold rush was triggered by Mercuriadis and his company, Hipgnosis. Hipgnosis spent billions acquiring the publishing rights of stars like Justin Bieber, Shakira, and Neil Young. At the height of the market, these catalogs were purchased at astronomical revenue multiples, as high as 25 times their annual earnings. The acquisitions were funded using a $600 million revolving credit facility, borrowed during an era of historically low interest rates. As global inflation rose and interest rates followed, the cost of servicing that credit skyrocketed. The fund's valuation plummeted under the weight of its own debt. Hipgnosis was forced into a distressed sale, eventually being acquired by the private equity firm Blackstone. The catalog boom was a debt-driven asset bubble that collapsed when market conditions changed, failing to live up to its framing as a cultural renaissance. Music rights have matured into a highly leveraged alternative asset class. The industry's projected $200 billion future is predicated on the monetization of superfans and the leverage of legacy catalogs. This model prioritizes investor returns over the wages of working musicians. The beneficiaries are the major record labels and private equity titans, who now operate as an oligopoly, controlling the financial value of the culture. The financialization of sound reveals a shift in priorities. Success is now measured by the predictable yield a portfolio generates for its shareholders. If you'd like to see which industry we investigate next, let us know in the comments. Like the video and subscribe to the Viral Scope.